Hey, everybody, welcome to the show. I have a question for you. Have you ever thought about raising capital for your business? Many entrepreneurs assume that raising capital means giving up equity, taking on restrictive debt, or waiting until they're much larger to access meaningful funding. But today's financial landscape offers more options than ever for growth focused companies looking to scale without sacrificing ownership. So, today we're going to talk about thinking strategically about financing, when debt makes more sense than equity, common mistakes often made when raising capital, and what it takes to build a business that's truly ready for growth. So, joining us is Michael Wallace, CEO of TIMIA Capital, who specializes in helping technology companies access non dilutive growth capital designed to support expansion while preserving flexibility. He's bringing deep expertise across lending and tech and works very closely with entrepreneurs and investment partners to design financing strategies that prioritize scalability and flexibility. And prior to joining TIMIA in 2024, Michael served as president of Torinit and the CEO of Findwork, a recruiting marketplace startup. He's also played a pivotal role at Longhouse Financial, joining as its first executive hire and helping scale it into Canada's largest alternative life insurance lender before its successful sale in 2022. So, Michael, welcome to the show today. We are really excited to have you here. Tell us a little bit about your background, because you have a diverse background. So how did you get from where you started to where you are now?
Thanks, Krista. Really excited to be here as well. You're right. I've done a number of different stops on the career path. I started my career in management consulting. Worked with a company called Bain& Company for the better part of a decade, and it was a great sort of very structured, very high performing, excellent place to start a career. Lots of great training, lots of great exposure. After being there for a little while, I had the opportunity to lead into a very entrepreneurial space. So very much a shifting gear for my career. As you mentioned earlier, I was the first employee essentially at a startup in the lending space. When I joined Longhouse Financial, we didn't really have anything at the time other than a few concepts. We built a product, we built a team, we built the infrastructure of a business that ultimately lent against life insurance policies. Life insurance policies are super boring, but they're really great collateral for loans. And we're based in Canada. We're based out of Toronto, and the Canadian banking landscape is very, very concentrated. The majority of the volume and lending volume in Canada goes through a handful of really large banks. And when you're a really large lender, it's very difficult to be creative and flexible. And that's what we were able to do as a small private lender. Really exciting to build that concept over the course of 5 or 6 years, build a great team, and we ultimately sold that business in 2022. I did a few things in the technology space, ran an early stage business, worked with a technology services business, and had a little bit of a full circle moment about 2 years ago when we had the opportunity to buy a business from the same folks that I had sold Longhouse to. This was a company that owned a variety of different private lenders, one of which was TIMIA Capital, the business I run now, which is a technology-focused lender. They weren't sure that it was the right fit to sit in their portfolio. They approached me and asked if I had any thoughts. I've been doing some work with a growth equity firm based out of Toronto, run for the TIMIA Capital at the same time. They were looking to do something in the technology lending space. So the timing worked out really well. I joke that it might have been the world's shortest search fund at sort of 24 hours. We spent a good chunk of 2024 diligencing and reviewing the business of TIMIA, ultimately acquired it at the beginning of November in 2024. And I joined the team and I've been running it now for about a year and a half. It's been really exciting.
That is an exciting journey. So, I think a lot of entrepreneurs immediately think of venture capital when they want growth funding. So, talk to us a little bit about non-dilutive capital, like what it is and why you think it's becoming such an attractive option for growing technology companies.
So a lot of things you can consider in this area. I think a lot of people immediately default to venture equity when they think of startups because that's what gets the majority of the press. You hear about rocket ships, unicorns, people getting massive amounts of money before they have any revenue for an idea. And for the right business, that can work really, really well. And for a long time in the early stage space, that was sort of the only option. There wasn't a huge variety of types of capital. As more and more capital, and particularly through the low interest period in and around COVID, as more and more capital came into the private markets, there became more and more nuances or slivers or slices of the market, all targeting the same types of businesses. So if you were running an early stage company, 20 years ago, your only option was to raise venture equity. Increasingly now, you can raise growth equity. You can work with a private equity firm earlier in your process than you might have been able to historically. There are a broader range of government funding programs. There's a broader range of angel investor networks that can source capital for you. And there's a broader range of non-dilutive options. In particular, the place where we play is the lending space. And that covers, I would call us growth debt, perhaps. There's venture debt. There's a number of different names there. But the most interesting aspect, I think, is not exactly what we do or exactly what somebody else does, but the fact that there is such a broader range of options for an early stage company. It is not raise venture capital or bust, so to speak. It's there's much more flexibility now, much more creativity in finding the right capital partner for a business.
So, how do you think founders should really evaluate that? Because you brought up a very interesting point, right? So, we're talking about debt capital versus equity capital. So, how should a founder or business owner evaluate that if they're looking to grow? When do you think each makes sense?
That last part of your question is exactly the important thing a founder has to consider is there is a set of facts at the founder or the business side, and there's a set of facts on the investor side. And facts, assumptions, priorities. The trick that a founder has in today's environment is making sure that their set of facts and assumptions and priorities matches the set of facts and assumptions and priorities of their investors. And the type of capital is a big part of that. So if you as a founder are looking for that venture rocket ship, spend at all costs for growth, very much a binary outcome. It's either going to be huge or it's going to be nothing. It's going to work or it won't. That is a return profile and a risk profile that equity is really well suited to underwrite. These big equity funds know that a number of their investments are going to turn out as zeros. They're okay with that. Their math works in a way that allows for that. When you are taking risky, high variability, maybe even binary outcome bets, that equity style of underwriting is required, right, for that risk profile. If you are a founder who wants a bootstrap business, who wants a business that is managed in a much more capital efficient way, a greater focus perhaps on being profitable early in your process and growing in a very measured and stable way, then the cost of taking on an equity investor can be pretty significant, both in terms of dilution and in terms of friction or stress when your outcomes or desired outcomes aren't in alignment with theirs. And that's where a partner like ours, like us, is a much better fit. We don't need you to be a rocket ship. We don't need you to, triple, triple, double, double over the next 4 years. We're looking for stable, repeatable, consistent growth. And a founder that really understands the dynamics and metrics of their business and is past the test and learn stage for the most part.
So, can you give us some examples of, say, a company, and no names, of course, but a company that you've worked with over the last year and how you were able to look at them and evaluate whether they were ready for capital and how their story turned out? What did they do with it?
We've worked with a whole variety of companies over the last little while. I'll give you a few examples. We work with a company in the fleet telematics space. So they use a combination of hardware and software to keep track of assets in, say, a trucking fleet or other mobile assets in enterprise fleets. And this is a business that was built over a long period of time. They have a long track record of success. They've been profitable for years, but they're relatively small. So they fit underneath the typical window that a bank lender would look at. And there's some variability in their profit as they pursue growth objectives, and as they have sort of timing of their annual cash flows and what have you. They've also found that when they have worked with banks, the covenants that a bank places on them are very restrictive. It doesn't allow them to manage their business the way they might want to. For instance, to go into a period of negative income as they pursue a growth opportunity, or to slow down growth as they focus on improving an aspect of their operations. This CEO, this founder, has also been pursuing a series of acquisitions to help grow his business. And every time he does that, his capital structure changes. He may need to bring on friends and family capital, small amounts of equity capital, and in many cases, take vendor take-back financing, where the seller essentially becomes a lender on his balance sheet until such time as deferred compensation is paid back. All of these things are typical. They're all complicated. And at the smaller end of the size spectrum, it's difficult for large institutional lenders to get their heads wrapped around that in a way that's efficient. A private lender like us can be a great fit. We can be much more like an equity partner for this individual as he pursues these opportunities without the dilution that comes along with raising equity in the business.
I love that. So I like the flexibility. I think, especially in today's landscape with all the things that are changing, and it seems like things sometimes are changing not just day by day, but hour by hour. I imagine, though, that you've got some stories on the flip side of that where you can talk to us a little bit about some of the biggest mistakes you've seen founders and business owners make when they're seeking funding.
The the issues we typically see when a founder comes to us looking for capital connects back to the concept I mentioned earlier, which is that alignment. So when we see a business and start to underwrite a business, what we want is consistency. We want consistency that the track record we're seeing is representative of the forecast that we're seeing. If you come and show us that you've grown at 6% a year for the last 10 years and your forecast says you're going to grow at 40% a year, that's great, but what is driving that difference? And is that a high risk bet on a change in your business? That's probably better underwritten by an equity investor. Is that, slow and consistent improvement where we can see evidence of that building over time? That's an area where soliciting or finding a lender like us is potentially a good fit. So the errors or the mistakes that we see is typically a founder who hasn't quite figured out that consistency in their business and hasn't connected their actual operations and their objectives with the capital source that they are looking to bring on board. If someone comes to us and they've got really short cash runway left and they're looking for sort of a make it or break it investment, like that's not a lender, right? That is an equity investment. So it's those sorts of misalignments that we see that are the sort of biggest, if you want to call it mistakes, the biggest mistakes that we see.
So it sounds to me like, and I do love this because I believe a lot in there needs to be alignment in everything that you're doing, right? From things like your workflows into your processes, into your product, and then right down with people and teams that you're working with. So is there any other things that you can think of outside of those that really make a difference to a business that scales successfully from those that you have seen really struggle despite maybe having access to capital?
We work with businesses at the smaller end of the size spectrum. Still great businesses, and compared to a sole proprietor or a small business, these are still pretty significant businesses. Most of the businesses that we work with generate between two and call it 15 or $20 million in revenue. Very established. Not all of them are cash flow positive when they come to us. Many aren't. Pretty wide range of types of businesses that we work with. Invariably, the ones that are the calmest are the ones that have really great data. And I don't mean big data, I don't mean complicated data or broad data, just good data. They have really clear visibility into customer level performance. They have really clear tracking around how much it costs to find and onboard a customer. They understand where in their process customers are falling off and what drives that fall off. And they've started to build responses to that, be it customer success, be it the compensation mechanisms for their sales team, be it the structure of their sales team. They use data to understand their own business and to start to tailor their efforts to make improvements. That's what gives a lender like us an incredible amount of confidence. When someone can come in and, their forecast is not just last month plus 3% every month for the next 2 years. It is built on saying, this is what we can typically do. This is what we proved we can do last year. This is the account plan that shows, the major customers or the major building blocks that build up to a forecast. When we can see that level of data and understanding, it gives us a ton of confidence. And having that data be the underpinning of that alignment that you mentioned earlier, it is something that we really enjoy seeing and gives us a ton of confidence that this is the type of business that will be a good steward of our capital.
So I was actually really fascinated when I did some research on how SaaS companies are producing data that contributes to whether somebody wants to come in and invest in them. And there was quite a few metrics in there that really I thought, wow, it could take some effort to really pull that kind of data out of everything that you've got in your CRM. If a business owner comes to you and they're like, we've got data, we just don't know how to pull it. Do you help with that? What do you suggest that they do?
We certainly can help. I think the challenge is that if you arrive with sort of a bunch of disconnected spreadsheets and one's out of date and one has customers that are have a customer number that's based on when they showed up and the same data shows up in another place with a customer number that's tied to their name or who knows what it is. It's hard to parse that through, and it's very difficult for a founder or an operating team to convey stability. What we typically recommend and see is that businesses at the scale we work with are often moving through a bit of a transition in their finance and operations groups. They've gone from a really early stage company where finance is kind of keeping the lights on, frankly, and not much more. They are doing invoicing, they're chasing down accounts receivable, they're managing accounts payable, they're often doing payroll. It's a very functional exercise, super valuable, but not the most strategic. And eventually, as they get to a certain scale, they find that they have to start to professionalize, for lack of a better term, that infrastructure. It's adding cost in some cases, which doesn't always have a direct track to revenue. So for folks who've been so focused on building revenue through the early evolutions of their companies, this feels a little foreign to them. But finding a more strategic finance resource that can help provide this structure, that knows the metrics that investors, equity or debt, are going to track, and can start to build the systems and processes to provide confidence in those metrics is really valuable. So we see sometimes that's bringing on a CFO who's been in a similar size business successfully before. Sometimes that's finding a fractional CFO who can work with your team to start building systems and processes. It might be hiring a VP of finance or a VP of analytics or something to that effect to augment your team. That's where we typically see a shift. Is you see businesses that come in somewhat disorganized and start to professionalize their finance teams. If we see them come in disorganized and they're really great businesses, we can still get there. It just takes a lot more work. And oftentimes we'll even require that sort of post-close, they bring on a stronger controller or a CFO or a VP finance.
So you've been both an operator and a capital provider. So what's something that you think investors and founders and business owners constantly misunderstand about each other? Is there anything that comes top of mind?
Yeah, absolutely. This is a really interesting one for me now sitting in the debt chair, essentially the lender chair, is there is a view, it feels like, that your lender is not the same partner as an equity partner. That we find that folks are often a little more cagey with us. They're a little less inclined to share information. And when you're going through a diligence process, I can kind of understand that, right? Like you've committed to getting capital on board, you want this deal to be successful, you're hoping to present yourself in the best light, right? Totally get that. at some point we've made a decision, right? Eventually we've written a check and we're on your cap table. And, in theory, there are aspects of a debt investment that are different than an equity one, right? If things, go offside based on the covenants that you agreed to as a borrower, could we call your loan or put you into default? We could. That's not the business we're in. We don't want to own these businesses. That's why we lend to them as opposed to make equity investments. But the part that I push hard with all of our borrowers is as soon as we've written that check, candidly, even before that, as soon as we've committed to writing that check, we are now a partner of yours. We want you to succeed. We want to be helpful, right? And that comes to bear almost more in situations where the business is having trouble than when things are going great. If things are going great, you don't need to talk to them very much. If things are going poorly, that's when we have an opportunity to be a great partner, and that's frankly when we build our biggest promoters is by going through tough periods with them and helping them through and out the other side. Whether that's being flexible around covenants, timing of payments, adjusting, amortization schedules to ease cash burdens. We can do all of these things if you come to us and ask us for the help, right? And that's probably the biggest. I don't know if misconception is the right term, but a good lender should be just as much a partner as an equity investor. And your trick as a founder, an operating team, or a board is to find that partner who's going to be with you kind of through thick and thin.
I think too, in a lot of the business that I've done, there really is a very big difference, I think, between a lender, as you're describing, and the lending in the traditional sense. I've done a lot of real estate investment, and I've seen a lot of real estate investors work with lenders where something did go sideways. And then, of course, they're in there right away to take something. I love what you said about not wanting to own these businesses, which is why you're lending to them rather than taking an equity position. So it sounds to me like if somebody that you're working with is struggling, they're going to pick up the phone, they're going to call you. What's the first thing that happens if that is actually the case? What's the first thing that you're doing in that instance?
In many cases, we know it's coming, right? We collect monthly financial reporting for our borrowers, and so we see the whole balance sheet, the whole income statement every month. So we start to see things happening in some cases even before they do. We notice that the balance between their payables and their receivables starts to change, and that they're running things, they're pulling in receivables as fast as they can, and they're deferring payables a little bit longer than normal. We start to see, the balance between customers added and customers lost start to shift. We see their cash balance start to drop a little more than normal or in a different way than expected. So usually it's not a surprise because we do have pretty good visibility into what's going on. Ultimately, what we'd love for our borrowers to come to us with is to say, this is the challenge we're having, right? We built our cost structure assuming a certain amount of growth, and for whatever reason, the growth is not materializing the way we hoped it would. Here's what I think I want to do about it, and here's my ask, if any, of you as my lender. That's a process that we would love to see, and that allows us to be very creative and flexible. At certain points in time, maybe the ask is different. Maybe it is, I've been banging my head as a founder or CEO against this wall for the last, 3 years, and it's not a breakthrough the way I hope it would be. I think it's the right time to find a home for this business that can give it more resources, different resources, a different focus. I'd like to sell this business. How do I do it? In many ways, the portfolio management work that we do, I joke is probably a third consulting, a third sell-side investment banking, and a third is like being a psychiatrist almost and being a sounding board for our founders or CEOs. So I think that's the sort of the mindset I'd love to get all of our borrowers into is we are a value-added resource just as much as an equity investor or a board member is. And if anything, we see the issues coming maybe even before they do.
I love that. That's fantastic. That to me is true partnership. And I think that's amazing. So can you tell us anything about the trends that you're seeing right now in SaaS and B2B financing?
It's been a very interesting 6 months to be a private lender in the SaaS and software space. There's been a lot written lately about the challenges of the private debt models. There's been a lot written about the challenges of the SaaS market and the impact that AI is going to have on the SaaS market. In some ways, I think a lot of it is overblown. I think the impacts are not, the direction of the impacts that are mentioned is not wrong, but it'll take much longer than everyone expects for those impacts to sort of flow their way through the ecosystem. We still see companies that are transitioning from on-premise software to cloud-based software. That's a transition that everyone assumed was dead a decade ago. So things move a little more slowly than everyone thinks. AI is absolutely the most significant kind of trend you see in the market right now, and the one that we're keeping. Obviously, we're big users of it ourselves. A lot of our borrowers are big users of it, and have incorporated it in various ways into their products. We have done a lot of thinking on how it impacts us as a private lender in the software and technology space, how it impacts our borrowers. How likely is it that our borrowers will still exist in five years? And what we've landed on, increasingly is our borrowers, any of the SaaS businesses that are out there, they have distinct knowledge of their customers. They have, are embedded in some way or another, different levels of depth into their customers' business processes. They should be a value-added partner to their customers. And they should be at the front line of making their value as significant as possible. And if that's driven by incorporating AI, they're very well positioned to do it. There are certain businesses out there that, that integration, that connection, that closeness to the core of their customers is significant, and some where it's less significant. Our job as we evolve our underwriting is to find more of those businesses where the connection is so significant that it can't be easily replaced. For us, that means systems of record. That means places where data is stored and held. That means businesses that have a hardware connection as well as a software connection to their customers, or a significant sort of business process, business service connection. And even if that means a lower gross margin, it means a greater connection to their customers. So it's changed a little bit how we think about certain businesses. It's definitely changed how we underwrite certain businesses.
So if you could leave us with one key takeaway, the most important thing you would convey to the audience, what would that be?
We've said it a couple times already, actually. For me, if you are looking for capital, find the right partner. And the right partner has a whole bunch of different things associated with it. But first and foremost, to me, that is alignment. Have a very clear point of view on what you want to do with your business as a founder or as a leadership team or a board, and a clear set of objectives and trade-offs associated with what you want to do with your business, and find a capital partner that's best suited to support that objective. Nothing will cause stress faster than when your investors want something different than what your business team wants or is capable of. Alignment more so than anything. And once you've found the right handful of partners, make your choice based on who's going to be the best actual partner for you. And who is the person that the firm that if things go poorly, are the ones that you want to have helping you through that process. But alignment's key.
So for everybody listening who wants to now work with you, as I think just about every business owner will at the end of this conversation, especially with how you are partnering with your clients, what is the best way for somebody to reach out and get connected with you?
Yeah, absolutely. So as a reminder, TIMIA Capital is the name of the firm that I run. We work with technology, SaaS adjacent, hardware, software, usage-based revenue model businesses. North America wide, typically 2 to 20 million in revenue is our sweet spot. So if that's you and you're keen to find capital that sort of fits with the sort of things that we've spoken about today, you can check our website out, TIMIAcapital.com. You can look for me on LinkedIn. Michael Wallace is easy to find, I think, and that's typically where folks will reach out to us. We're readily available and always happy to chat through different aspects of your fundraising objectives and business priority setting, all of that, to see how we can be helpful.
Awesome. Thank you so much for joining us, Michael. All right, everybody. So you heard it here first. If you are looking for that next level growth partner for your business, you definitely want to be out looking up Michael on LinkedIn. You want to be checking out TIMIA Capital on the internet. All right, everybody. Thanks so much for joining us. Until next time.